With oil in a rapid decline this year, many investors are wondering if there is any value in buying up oil stocks in the coming months, as it's commonly believed the industry is now heavily oversold. One company that is at the forefront of this conversation is ExxonMobil. With 37 oil refineries in 21 countries, constituting a combined daily refining capacity of 6.3 million barrels, ExxonMobil is the largest refiner in the world and one of the biggest oil and gas producers globally. To give you some perspective, in 2018 their revenue totaled $279 billion. That is twice as much as Microsoft, one of the world's largest, most valuable companies, and nearly 14 times bigger than that of McDonald's. While being one of the world's largest businesses by revenue is a big deal, it's not what brings ExxonMobil into the spotlight these days. With the market in a downturn, there is a large focus on the company as is believed by many to be one of the most oversold stocks on the market right now. Trading as high as $95 per share in years past, Exxon has tumbled down to $47 a share. Investors are deeply intrigued by it not only because of its historically low price, but by the insane 7.35% dividend yield being offered right now. With the oil market in complete freefall, it does not come as a surprise that many are speculating a bottom soon, and buying the bottom begins with buying Exxon. While this bet may seem obvious, fear in the market is being driven by a number of concerning figures. For an example, the XOP, an ETF tracking an equally weighted index of companies in the US oil and gas exploration and production space, is down over 50% on the year. US shale companies are facing complete collapse as oil prices have fallen to the low 40s. OPEC has failed to cut following a large fall in demand globally, and an oversupply in the market is driving prices to record lows. What's to come may be either the greatest opportunity of the year or one of the largest trap investments of the 21st century. In this video, we attempt to find out by going deep into the history and financials of one of the most important companies in the world. The American multinational oil and gas giant ExxonMobil, headquartered in Irving, Texas, has quite the history. It is the largest direct descendant of John D. Rockefeller's Standard Oil and was formed on November 30th, 1990 by the merger of Exxon, formerly the Standard Oil Company of New Jersey, and Mobil, formerly the Standard Oil Company of New York. Today, its primary brands are ExxonMobil Esso and ExxonMobil Chemical. If you've driven a car, flown on a plane, drank from a plastic cup, or flicked on your lights at home, you most likely have contributed to the profits of this company. Going back to its roots, both Exxon and Mobil were descendants of Standard Oil, established by John D. Rockefeller and Partners in 1870 as the Standard Oil Company of Ohio. Following a number of mergers, acquisitions, and takeovers from 1870 to 1911, Standard Oil grew into one of the largest corporations in the history of the world. In 1911, it was forcefully split up into 34 separate companies by the United States Supreme Court in a famous case that was mostly inspired by public outcry. Two of these 34 companies were Jersey Standard, which eventually became Exxon, and Sokonoy, which eventually became Mobil. From 1911 to 1950, both of these companies grew quickly on their own, taking on projects around the world, expanding production and refining capabilities while diversifying into a number of different areas throughout the globe. Exxon was put into the global spotlight in 1989 after one of its oil tankers spilled nearly 11 million gallons of crude oil into Prince William Sound, effectively crippling wildlife and the untouched coastline of Alaska in one of the most breathtaking areas of the world. Naturally, being one of the richest, most powerful companies in existence, Exxon continued to prosper despite public outcry concerning the event. Finally, in 1998, Exxon and Mobil signed a $73.7 billion merger agreement, forming a new company called ExxonMobil, the largest oil company and the third largest company in the world. This was also the largest corporate merger at the time. Exxon was the world's largest energy company, while Mobil was the second largest oil and gas company in the United States. What also made it unique is that it reunited two of the largest companies of the Standard Oil Trust, ushering in a new era of dominance by a direct descendant of the company's founder, the late great John D. Rockefeller, the richest human to ever live, supposedly. Alright, enough with the history. The 2000s saw ExxonMobil grow even bigger, expanding operations by acquiring and expanding more and more assets throughout the world, growing into a company that became the largest non government owned business in the energy industry and produces today about 3% of the world's oil and 2% of the world's energy. On the operations side, ExxonMobil is organized functionally into a number of global operating divisions. These divisions are grouped together into three major categories for reference purposes. Though the company has also several ancillary divisions such as coal and minerals, which are standalone, it also owns several hundred smaller subsidiaries such as Imperial Oil Limited in Canada and Sea River Maritime, a petroleum shipping company. But like I mentioned earlier, the bulk of its business falls into three major categories, which are upstream, downstream, and the chemical division. To understand the business, you have to understand the upstream portion. This division makes up the majority of ExxonMobil's revenue, accounting for approximately 70% of the total. When we think of oil companies, we think of oil platforms and rigs, and this is exactly what this division does. Exxon's platforms and rigs can be found all over the world, from Africa to Russia to the Middle East and Mississippi. Anywhere you can sniff oil and gas, ExxonMobil has probably been there. The company has so many locations in its upstream operations, listing all the countries would be pointless and probably take up most of this video. Instead, we're going to focus on the profitability of this division. What makes this so special is that this varied and diversified portfolio allows ExxonMobil to absorb risks attributed to any number of factors. Whether it's political unrest in Africa or a hurricane in the Gulf of Mexico, their large upstream global profile is spread out over 41 countries, enabling ExxonMobil to meet the world's growing demand for energy, while also creating value for resource owners and shareholders. In 2018, it produced 3.8 million barrels per day, with 59% liquids and 41% natural gas. New projects are set to expand its capabilities with new discoveries enabling it to grow in a market where depletion is sure to reduce the supply and increase value. While its peers operate a similar business model with the same goal, they fail to do so as successfully, as evident in lower margins and returns compared with Exxon. Exxon generates its superior returns from the integration of low-cost assets combined with a low cost of capital. This combination produces returns greater than that of its peers by placing it in a dominant position in the energy sector. Based on analyst remarks, in the near term, these new project metrics may suffer, but ultimately, these projects should bolster competitive position with an average break-even price of $40 per barrel. All this sounds nice, but it doesn't come without the risks. Following the coronavirus outbreak and the failed OPEC meeting, which has shot oil prices down to historic lows, I believe there is no better time than to buy right now. The S&P 500 Energy Index has already lost over 50% of its value going into 2020 following the outbreak of the virus. Ultimately, I believe this to be a severe overreaction, and eventually prices will recover to historically normal levels. Although models were estimating a demand for 2020 to be at 1.25 million barrels per day, this is now estimated to be 960,000 barrels per day, a 23% decrease due to the virus, which I find a bit ridiculous. Ultimately, the entire bull case on Exxon rests on a relatively binary question. Will demand for oil grow in the next decade? And that question has been the subject of intense debate among experts. Developments in alternative energy and technology may act as a disruption to the entire oil industry, and I have no doubt that this is going to be true in the long term. But my play on Exxon is not based on a decades-long play, but instead a years-long play. I believe the current situation makes Exxon very oversold, and in the near term, prices will rebound to expected levels given the cyclical nature of the situation, just like 2008. However, if we take our short-term lenses off and look out into the horizon, there are concerns. ExxonMobil is not a long-term play for me because there are significant headwinds it's going to have to come to terms with in the near future. Management is very bullish on oil and believes the long-term price over the next decade to be over $60 a barrel on average. Demand has been shaky over the past few years, but according to their estimates, emerging markets should make up for that in the coming decade. They have put their money where their mouth is by spending nearly 75% of their cash flow into projects, as discussed earlier, in order to grow even further. The problem with that assumption, though, is that there's heavy risk in assuming an average price of $60 a barrel in the next decade. For one, alternative energy is on the rise, and electric cars, solar, and wind demand will only go up from here as technology advances and the prices on these alternative forms of energy decreases. So what happens to the model if we assume an average price of $40 a barrel over the next decade? The earnings fall short and their plan goes to crap. Exxon justifies these models by placing emphasis on certain patterns they see developing around the world. For one, they believe average standard of living continuously increasing around Earth, making consumption of oil rise. GDP per capita for Earth has increased from 8,884 in 1990 to 15,293 in 2017, and they don't expect this growth to stop. Along with that, increases in life expectancy and other facts contribute to their assumption of greater demand and thereby higher prices. Their estimates put wind and solar at 3% of the world's total at 2040. This thinking is pretty flawed in my opinion, as countries with the most amount of growing to do sit in areas with significant sun irradiance. India, Malaysia, Indonesia, Philippines, they can and will produce a large amount of energy from renewables, especially if costs and technologies improve, which they will as costs continue to go down and down. These technologies are developing at record-breaking speed, and Exxon is sort of oblivious towards it. According to other analysts and experts, global use of renewables may be as high as 50% in 2040, which of course would blow Exxon estimates and profits down the drain. To make things even worse, if we look at where Exxon is investing its money, it's mostly placing its bets on shale and deepwater rigs. Those are the first ones that will be hit in this transition. On top of that, we are expected to get further disruptions for better, more fuel-efficient combustion engines, electric drivetrains, and a well-understood expectation of energy storage to explode. For an example, Bloomberg's estimates are that energy storage increases are going to be 120 times bigger by 2040, which should act as a giant disruptor to the market. But enough with that, and let's get into the specifics. As we continue to trend down due to the virus, my play will be to buy Exxon at 43 a share and hold it until 47. The large dividend and the expectation of oil to at least rebound slightly in the next year should be enough to give you a nice 10% return on investment. Remember, I'm only talking about the near term, and I expect fully that ExxonMobil's long-term price will only continue to trend down. Let me know what you guys think about this play. Are we catching a falling knife here or making a smart swing play for 2020? If you enjoyed the video, please make sure you hit that subscribe button, and as always, thank you for watching.